Welcome. This is the cover of the Lumina Flow Explained Simple Guide, the field manual for reading dealer positioning to anticipate where price will be pulled next. Quick orientation before we dive in. Lumina is not a prediction tool, it's a reactive read on forced flow. The framework rests on a single observation. When retail and institutions buy options, dealers on the other side are forced to hedge with stock. That hedging is mechanical, large, and predictable, which means the dealer book itself becomes a leading indicator for where price gets pulled. The 13 chapters split into two halves. Chapters 1 through 7 build the mental model: who Lumina watches, what signals it produces, what the 3 pillars mean. Chapters 8 through 13 turn that model into trades, flow confirmation, heat map reading, the 4 setup playbook, max pain dynamics, the GEEX flip, and the pre-trade checklist. The big idea is this: Lumina does not predict the future. It watches the people on the other side of every options trade, the dealers, and tells you what they will be forced to do next. When dealers must buy, price goes up. When they must sell, price goes down. That's the whole game. The seesaw on this slide is the mental model. Every options trade has 2 sides. You on one end, a dealer on the other. When you buy a call, a dealer somewhere sold it to you. That dealer is not making a directional bet. They are a market maker whose job is to stay delta neutral. The moment they sell you a call, they are short delta, and they must immediately go buy the underlying stock to neutralize the position. That hedging is forced. It is not optional, it is not discretionary, it is not based on opinion. And in aggregate across all dealers, it is enormous. Millions, sometimes billions of dollars. Oh, this is the workflow. Memorize this sequence. Every chapter of the guide lives inside one of these 5 boxes: signal, pulse, flow, levels, trade. Step 1, signal, answers which way: buy calls, buy puts, or sit out. We cover this in chapters 2 and 4. Step 2, pulse, answers how strong. A 0 to 100 gauge that tells you how aligned all 4 dealer positioning ingredients are. Below 50 is wait or skip territory. Above 65 is tradable. Above 85 is rare and gets a size up. Chapter 3, Step 3, flow, answers is smart money agreeing. We look at institutional option flow, sweeps and blocks, to confirm or refute the dealer positioning read. When flow agrees with GEX, you have your strongest setup. When flow conflicts, you have a trap. Chapter 8, Step 4, levels, answers where to take profit and where to stop. King nodes are the runner targets. Sentries are the first take profit. Walls are your street. 3 signals, that is the entire universe of Lumina output for a given symbol at a given moment. Buy calls, buy puts, or neutral. 2 are tradable. 1 says stand down. Buy calls means dealers are long gamma. They have sold puts on net, or they are net long calls. When price dips, they are forced to buy the underlying to stay hedged. That buying lifts price. Dips get caught. Rallies grind higher. Volume stays low. Smooth, trendy up environment. Buy puts means dealers are short gamma. When price drops, instead of buffering it, they are forced to sell more of the underlying, which makes the drop accelerate. Cascade-style sell-offs. Volume explodes. Air pockets to the downside. Neutral is the one beginners ignore at their peril. It does not mean a flat, boring day. It means the 4 ingredients: net GEX, VANA and VEX, bull-bear ratio, and king node strength are pointing different directi. The pulse is the single most useful number in Lumina. It collapses all 4 ingredients, GEX, VEX, bull-bear ratio, and king strength, into one 0 to 100 reading. One number, one decision. Think of it as a thermometer. Above 65, fever. Dealers are forced into clear action. Take the trade. Between 50 and 65, warm conditions are tradable, but reduce size 25%. Between 35 and 50, tepid, wait, do not trade. Below 35, cold, sit out, or consider the opposite direction. 6 possible labels, and only the top 3 are tradable. Strong buy around 88 is rare, maybe a few times a month per symbol. When you see it, you should be more aggressive, not less. That is a sizing up moment. Bullish setup and bearish setup in the 70s are bread and butter, normal trade days. Mixed at 52 means the ingredients are disagreeing. Wait, stuck in range at 54 means price is pinned, sell premium, scowl. A king node is the single strike where dealers have their largest gamma position, because their hedge has to be biggest at that strike. Dealer behavior at that strike has the biggest effect on price. Price gets pulled toward the king like a marble to a magnet. There is always one king above spot and one king below spot. The question every snapshot answers is, which one is stronger? Lumina shows you with a pull ratio. 3.3 times bear means the lower king is 3.3 times stronger than the upper king. Price will gravitate down to it. On this diagram, spot is at 710. Upper king is at 720 with magnitude 1. Lower king is at 700 with magnitude 3.3. The pull ratio is 3.3x to the downside. Lumina would print buy puts on this snapshot. Target 700. The reading rule, king above plus winning ratio equals upside magnet. Buy calls. Target king above. King bell. The sentry is the second strongest gamma node. It sits between price and the king. Think of it as a speed bump on the road to the king. Price often pauses at the sentry before continuing, or reverses there outright. This is the single most important risk management concept in the whole framework. The sentry is your first take profit. Always. Without exception. The trade plan looks like this. Enter near spot. Scale out half the position when price touches the sentry. That locks in profit and reduces emotional pressure on the runner. Let the other half run to the king. This combo does two things. First, it dramatically improves your win rate because the majority of trades go partway and stall before reaching the full king target. Second, it lets you keep the big winners that DO make it all the way to the king. You do not have to choose between win rate and reward. The Sentry King STR. GEX and VEX are the two engines underneath every Lumina signal. GEX is gravity, where price wants to go. VEX is wind, how fast and smoothly it gets there. Both together tell you direction and velocity. Positive GEX means dealers are long gamma. They make money when price stays still, so they actively buy dips and sell rips to dampen movement. Result, price grinds in a range, volume stays low. This is the pin or rally to king environment. Favors call buyers because every dip gets bought back up. Negative GEX means dealers are short gamma. They lose when price moves hard. When price drops, they are forced to sell more, accelerating the drop. Sell-offs cascade. Volume explodes. This is the break-and-go environment. Favors put buyers because dealer hedging amplifies the downside. Then VEX, the volume piece. Volume crush happens after news passes or near expiry. Implied volume falls, dealers buy stock. DEX is the third pillar. It tells you whether dealers right now are sitting on a pile of long stock, meaning they had to buy a lot to stay hedged, or a pile of short stock, meaning they had to sell. Why this third pillar matters? GEX tells you where dealers are, structurally, their option positioning. VEX tells you how the volume regime is shifting their hedging. But DEX tells you what they have already done about it, their current share inventory. It is the realized state, not the theoretical state. When all three pillars agree, you have triple confirmation. Structural setup, volume regime, and current inventory, all pointing the same direction. That is triple green, maximum bull conviction, time to size up calls. Triple red, all three pointing the other way, maximum bear conviction, time to size up puts. 2 of 3 agreeing is the normal trading day case. Take the trade, but reduce. GEX shows where dealers SIT structurally. Flow shows where institutions are betting right now, in real time. When the two agree, you have the strongest possible setup. The structural read confirmed by aggressive money on the tape. 3 flow types, in order of urgency. Golden sweeps are rare, at least $1 million in premium, hitting multiple exchanges simultaneously, with high open interest ratio meaning brand new positioning. When you see one, somebody with serious capital needs IN, right now. Pay attention, these are the rare gems. Sweeps are the workhorse. 100,000 plus in premium, multi-exchange, market orders paying the spread to get filled fast. These are directional bets by institutions. This is your bread and butter flow signal, what you check on every trade. Blocks are large prints on a single exchange, often dark pool. The size catches your eye, but blocks. The heat map is a color-coded grid of every strike across the next few expiries. It is the single most information-dense view in Lumina. Once you can read it in 10 seconds, you do not need most of the other charts. Green sells pin price, that is positive gamma at that strike, dealers buying dips. Purple sells amplify moves, negative gamma, dealers selling on the way down. The brighter the color, the stronger the effect. Gold stars mark the kings, biggest gamma at that strike. Cyan check marks mark the sentries, second biggest. Read this example top to bottom. Spot is 711. Above spot, lots of bright green with the king at 720. Dealers will catch dips and lift price towards 720. Below spot, lots of purple with the king at 702. If price breaks the 708 level, dealers will sell harder and price cascades down to 702. So this snapshot resolves into positive GEX environment, dominant GRE. 4 setups. That is it. Once you have watched the market through Lumina for a few weeks, you will realize the same 4 patterns reappear constantly. If you can name the setup within 10 seconds of opening the chart, your trade plan writes itself. If you cannot, do not trade. You are guessing. Pin rally is the most common bull setup. Positive GEX, volume crushing, DEX buying, spot sitting below a king above. Dealers will lift you. Buy calls, target the king. Scale half at the century, stop 1% below spot. This is the easiest setup to recognize and the easiest one to size up on when conditions are clean. Break and go is the bear equivalent, but it moves fast. Negative GEX, volume spiking, DEX selling. The discipline here, only enter after price has broken the support wall, not before. Predicting the break gets you stopped on every fake out. Wait for the break, then enter. Move quickly. Max pain is the strike where the sum of all open option positions causes the maximum total dollar loss to option buyers at expiry, which is the same thing as saying maximum dollar profit to dealers who sold those options. So as expiry approaches, dealer hedging, the same forced behavior we have been talking about for the whole deck, literally pulls price toward max pain. The dealers want it there. They have structured their book to make money if it lands there, and their hedging activity, in aggregate, gets it there. On this chart, spot is 712, max pain is 710. Above price at 720, call buyers stand to lose $18 million if price stays put. Below at 700, put buyers stand to lose $17 million. At max pain 710, the combined losses peak at $67 million. That is the magnet, the deepest part of the gravity well. How you actually use this, max pain is a Friday thing. On weekly expiry D, the GEX flip is the strike where dealer gamma changes sign. Positive on one side, negative on the other. Cross it and dealer behavior literally reverses. What was buying dips becomes selling rips. What was a trampoline becomes a slide. The mental model. Imagine a trampoline park with a painted line on the floor. On one side, the floor is bouncy. You fall, you bounce back. On the other side, the floor is a slide. You fall, you keep going. The painted line is the GEX flip, and crucially, the line can move during the day as positioning changes. Sometimes price chops back and forth across it. That is the worst environment. 6 cases, 6 behaviors. Cases 1, 2, and 3 are, we are clearly on one side, easy to trade. Case 1 is trampoline, above the line, range bound, buy dips, sell premium. Case 2 is slide, below and going down. Buy puts on breakdowns, do not catch knives. Case 3 is CLI, Case 1, trampoline. We are above the flip. Dealers are long gamma here. Every time price dips toward the flip, dealer hedging buys it up. Every time price rallies toward the ceiling, dealer hedging caps it. The result is a bouncy, range-bound chart with predictable extremes. Your job in Case 1, scalp the range. Buy calls on dips toward the flip, take profit toward the ceiling. Sell premium with iron condors or strangles. Volume is low and decaying. Theta is on your side. Stops are tight because if the floor breaks, regime changes immediately to Case 4 territory. High hit rate, small targets, but lots of opportunities throughout the day. This is the setup that pays the bills on quiet sessions. Case 2, slide. We are below the flip and trending down. Dealers are short gamma. Every time price drops, dealer hedging sells more, which makes the drop worse. Bounces get sold into. Trying to CA. Case 3 is the mirror of Case 2. Same mechanic, opposite direction. We are above the flip, trending up. Dips get bought by dealer hedging. Price climbs steadily toward the king above. Buy calls on the dips. Target the king above. Stop is a clean break of the flip, not a wick, a clean break. Wick tests of the flip are normal in this regime. Closing prints below are not. Case 4, cross down, is the most expensive trade to get wrong. Price crosses the flip, going down. New traders short the cross immediately. They get squeezed by the next bounce. The correct play is to wait. Let price come back up and touch the flip from below. If the touch fails, price rejects the flip. That is your short entry. If the touch climbs back through, the cross was a fake out, no trade. Case 5, cross up, is the same principle in reverse. Price crosses up through the flip. Do not chase the cross. Wait for the pay. This is the most important slide in the deck. Print it. Tape it to your monitor. Read it before every single trade. 6 checks. Every check is a separate question. Every check has to come back yes. No partial credit. No, this one is close enough. Check 1. Signal is buy calls or buy puts. Not neutral. If you have to squint to figure out which direction, the signal is not clear enough. Wait. Check 2. Pulse is bullish or bearish setup. or stronger. Mixed means wait. Skip conflict is the dangerous one, because it can look tradable on the surface, but the underlying engine is in conflict. That is a trap. Walk away. Check 3. Flow agrees with signal direction. Flow checkmark on the card. If flow disagrees with GEEX, you have the void configuration, historically the lowest win rate setup in the entire framework. The cleanest skip in the whole system. Check 4. No air pocket warning. This is the close. The whole framework distilled into one sentence. Lumina shows you where dealers are forced to act. You wait for the signal, confirm with pulse and flow, set your levels at the king and the wall, and only press when everything agrees. That is it. Everything else is detail. Your job is process, not prediction. The market does not owe you trades on any given day. Some days have clean pin rally setups at 10 a.m. You take them, you make money. Some days have nothing but chop, and the right answer is to read a book. Both are correct outcomes of running the same framework. The ribbon at the bottom, signal, pulse, flow, levels, trade, is the workflow you will run hundreds of times if you stick with this system. 5 steps. Every time. No skipping. The single most common way traders lose money with this tool is shortcutting one of those 5 steps, because they were impatient.